Hey everyone, this is Mark Treichel with another episode of With Flying Colors. I'm here today with Todd Miller, and Steve Farr. How you guys doing in Montana? Mark?
The weather's not bad. Not bad. A little cold, a little windy.
A little cold, a little windy. We're recording this, January 26th, 27th,
Six.
Monday. 26th, Monday. The whole country, other than Florida where I'm at, it's really cold. It's about 80 degrees outside, and we're going to have a cold snap's going to fall in the 60s here as your weather moves towards us. But we're here today to talk about NCUA's priority letter. I did a 10,000-foot priority letter podcast last week the week after the letter came out. The three of us were on a cruise, the Q's cruise, with Scott Gladden and his team at Innovations and a bunch of credit unions from Florida and Georgia that we just got back from. It was good seeing you guys face to face for the first time in a while and meeting some credit unions. We had some discussions there about the priority letter, and we're going to talk about the priority letter here today. In our pre-call, we said, hey, it's short, so that's one takeaway we'll have, I'm sure. But with that, guys, I'm going to let you do your intro in case somebody's listening the first time. And let's start with Todd.
Good morning, everyone. I was with NCUA for 34 years, from 1987 to June of 2021. I could break my career into three pieces. About the first third, I was an examiner, problem case officer in the Western region. Middle third of my career, I was a capital market specialist for 10 years or so in the Western region. Again, had a lot to do with the development of NCUA's exam programs around interest rate risk, a lot of the teaching priorities around interest rate risk and liquidity. The last 11 years or so of my career, I was a director of special actions in the Western region, where I supervised problem case officers, capital market specialists, regional lending specialists. Over my career, I was involved in helping a lot of credit unions with no capital survive. Served a couple credit unions, returned them to the members. And unfortunately, I was involved with closing a number of credit unions too, where the NCUA kind of failed along the way to do its job. But anyways, very enjoyable 34 years with NCUA. I retired a couple months, and Mark said, hey, you want to come help credit unions from the other side? And I said, sure, sounds like fun. And it has
been a lot of fun. And Steve.
I can summarize mine also in the thirds. My first third is the same as Todd's. In fact, we worked together a lot during our first third of careers in credit unions. And then I followed you, Mark, when you went to the central office. I started working at the Division of Risk Management and did that for 15 years. And that one was highly diversified, but I was really involved in all of the material exposures that NCUA had. One of my duties was calculating the loss exposure to the insurance fund. So that made me meddle in all of anything that exposed the insurance fund to large losses. I got to do training of the problem case officers. That was really enjoyable. I missed that one more than anything. I finished up as the vice president of the CLF. And then upon retiring, I did a short stint as a CFO in an NCUA conservatorship in Manhattan. And that was my first switching over to being on the other side and battling the NCUA examiners that were in our credit union at the time. And then since then, I've really enjoyed this ability to do the consulting on these areas. And like I tell everybody, it allows us to keep our saws sharp in the industry. And I think that's been a great opportunity.
Yeah, I agree with that, all of that. And I had 34 years at NCUA, Minnesota, Dallas, Concord. The best office NCUA ever had was in Concord. We closed that at somewhere along the line, moved it to Phoenix. From Concord to Albany to DC to Albany to DC, and now for the last 6 years, helping credit unions and having fun on this podcast. But with that, so NCUA's letter 26, CU01, which means it's 2026 and it's the first letter of the year. NCUA's 2026 Supervisory Priorities. I joked in the past at one juncture when they had 12 or 13 priorities that if everything was a priority, nothing's a priority. And more recently, they have less, and you can ascribe to the less is more, but then sometimes they bury certain things into the less, and the priorities rear their ugly head along the way. So with that, let's just walk through the letter. There's discussions on the front end about no regulation by enforcement, which we've talked about here. There's the obligatory reference to the Genius Act. And I say obligatory because Kyle Hauptman's big on that whole arena. And I'm sure he, as chair who signed it, made sure that was in there. And then they pivot into the supervisory priorities themselves. And the first one listed is a broad title, balance sheet management. Guys, what do you want to say about NCUA's letter to credit unions on balance sheet management? What's there, what's not there, et cetera?
Mark, can I just touch a little bit on that introductory section that they
yeah,
have?
absolutely, Steve.
I don't think we can talk about priorities in 2026 without addressing that NCUA has to do their exam program with the big reduction in staff, which of course you would hope that they would be focused, as they said, on shift the areas of focus based on the risk profile when appropriate. What I see in our fellow regulators, that they're really clear in that they're going to shift to focusing on what they call prioritize material financial risks. So they're really said they're going to be backing off on things like processes and procedures and only address those items that present the most material risk. And that was all that they would write their matters are crying attention on, is those big issues. So I think that's important to think going forward, that you're dealing with an exam staff that's going to be stressed, and hopefully they will be focusing on the big issues.
I have another little take to it too. I highlighted 4 sentences in the whole letter, and a couple of them were actually right before the Genius Act. Improved efficiency and reducing burdensome work, creating a more efficient tailored exam program. Seems like that process was going on the whole 34 years we were at NCUA. And I think when we were on the cruise, you did a whole little piece and you had podcasts on the chaos at the agency, 27% reduction in force. I think it boils down to is NCUA saying, we're going to do our job, but we haven't figured out how yet. And I talked to an examiner here not too long ago. They presented the reorganization plan to their staff in December. And the way he characterized it is, there's a lots of to be determined in all the slides they gave the examiners. So I think they know what their mission is. They're going to focus on doing their mission. They haven't figured out how to do that with the resources that are probably not enough for them to do that in 2026.
Yeah, said, yeah, the language here, the creating a more efficient and tailored exam, is a nice way to say we've got some chaos and we're in the middle of trying to figure out what that is. And there's clearly dust still in the air, and we've seen it trickle into exams. But the good people at NCU are doing what they can. And this is probably a bad analogy, but you're in a band together and you've got a repertoire of different songs, and you show up and you decide that these are the 10 songs you're going to play instead of those are the 10 songs. And maybe you wished you'd have practiced them. If you'd known it was going to be then 10, but they have the knowledge, skills, and abilities that they have from their, and the muscle reflex of doing exams, right? And you just don't have as many resources. And you're hearing from over here that this is your team, and you're hearing from over here that this is your supervisory examiner. And you go in and the clock ticks and you do the exam, and it says you got to be at the next place, and you meet with the people and you just keep the ball. So they do their own triage, right? That each individual kind of has always had their own risk-based assessment in their brain on how they were going to do it. With less resources, that becomes more important. Part of the challenge is they lost a lot of talented long-term people.
Yeah. Todd pointed out the comment there that they're going to try and do more efficient and tailored exam programs. And we can't forget the NCUA did send out the notice that says the tips on starting exam effectively. I think credit unions should keep that in mind and hold NCUA accountable on those time frames that they've been giving the 4-week notice, and so that your examiner is following that, because that will make for an efficient exam. Where the examiner isn't doing that has an impact on them and you. And this letter clarified that, which is great. Another thing that happened in October, though, from the other financial regulators, I just thought I'd take this opportunity to discuss. They have finally, for the first time, defined unsafe and unsound practice It's always been a little bit of a nebulous concept. It was in some case law, which is just really difficult. But they did it. It's pretty short definition. I'll read through it, or because it won't take but a second. It is defined as a practice, act, or failure to act, alone or together with other practices, acts, or failures to act that is contrary to generally accepted standards of prudent operation and has materially harmed the financial condition of the institution, or if continued is likely to materially harm the financial condition of the institution or present a material risk of loss to the insurance fund. So it's a simple definition, but we finally have one.
So I remember that having been proposed by the other regulators. So it's finalized now.
It was in a proposed rule, but yeah, I think because of it being there, that would be a standard that would be used going forward.
Sure. But and as great it is to have that definition, and it probably provides some clarity, it still comes down to interpretation, right? You can't, no matter what what words you provide, you can have a little bit of wiggle room around that. It'll be interesting to see if NCUA does anything, come up with their own definition or copies that one. Thing else on the paragraphs that I summarized before we get into the balance sheet management?
Nope. Have a lot more. What does this mean? But those are for the end after we're done with this.
Okay, very good. Steve, balance sheet management. We've got loan growth that has moderated in recent years while loan performance has declined. The overall delinquency rate and rolling 12-month loss rate in the federally insured credit union portfolio is at its highest point in over a decade. Anything there that jumps out at your number crunching?
We don't generally agree with that statement.
So like we had a client, they were growing about 8% a year, and NCUA said, your growth is high and risky. It's the same thing in this statement. That's almost a summary of what they used in last year's letter. And it was true that loan quality was deteriorating over 2024. It's not true in 2025. It stayed virtually the same. And so they imply that asset quality is deteriorating, but that's not what the numbers show for the first 9 months of 2025.
The stats don't support it. It's kind of, I remember one time when NCUA says they're going to renew the 18% rate for federal credit unions to charge, they have to show some instability of rates, or that rates have gone up and down, and tie it to some data. And I remember one period there was like one blip where they were able to say that it qualified. They're making a statement to make sure people are watching their loans, but the stats don't necessarily report what that sentence implies. Is that what we're saying?
Yes. I think it's interesting. You look at last year, they laid out specifics. They talked about loan underwriting, collections, concentration risk, board reporting on significant programs. That was in last year's letter. This year, they said, we're just going to pick whatever we think is going wrong in this specific institution. They do mention credit risk concentrations again, but overall, they don't mention anything specific. And at the end of the day, credit risk is what causes the insurance fund most of its losses. And they're basically going to say, we're going to pay attention to credit risk. It's interesting when you look down there at lending resources, those are all the same resources they cited last year, with the exception they took a couple out about adjustable rate ARMs, and they also took out a reference to evaluating real estate modification programs. And it's interesting that you take that out when, they're concerned about real estate lending, and really residential real estate and commercial lending were the only loan programs that really grew through the first 9 months of 2025.
Interesting. Steve, any thoughts on that?
Yeah, I looked at, they're going to focus on the credit risk management, underwriting standards, and loss mitigation programs. Those are areas that I think as credit unions move towards using data that they have and the ability of AI and stuff, I think there's going to be strong improvement in that area, and that credit unions should be quicker to respond to what they're seeing in general membership. So I am optimistic in that area, as the early recognition of credit problems will help in this area. And I think as you use good systems to do your underwriting, that loan quality will continue to improve as long as there aren't kind of external factors that aren't really related to credit that don't affect the system. Whereas like that issue with maybe having a 10% thing on credit cards, that certainly changes the whole model.
Sure.
So I think people are probably going to be, I think we see improvement in credit risk management in the industry. And I think this will be a big year for credit unions to be able to improve that process.
And of course, the 10% credit cards you're referring to is President Trump's command last encouragement that be something that would be put in place. I did a full podcast on that. And obviously that would take an act of Congress and would impact a lot of things. And it's just not going to play out. But it's an interesting sidebar of all this. Now, one sentence that caught my eye on this was when lending, servicing, or collection functions are outsourced, examiners will also assess the third-party risk management practices as appropriate. NCUA with loan participations, but even them linking it to like the outsourcing of collections. The collections kind of word caught my eye here. I'm wondering if they've seen some things where collections have been outsourced and they didn't like how it may have been handled. Of course, we know there have been a lot of different scenarios where participation loans have created some challenges in how they handle those with third parties. Any thoughts on that? What I just said or that sentence at all?
I don't know. There's always been credit unions that have outsourced parts of their collection. Most often you see they prompt that early piece where, it's 10 to 60 days, or they throw out the back end piece after we charge it off. And there has been some frauds over the years in areas related to outsourcing collection actions. There has been consumer complaints. They're small and very isolated. And over time, this is something that's just many credit unions have found it effective. There's always been a piece of the industry that has outsourced collections either on the front or the back end. Be interesting to see if more of that goes on in the future. Because of various debt collection practices, you have more flexibility to keep things in-house. There's things you can do in-house that you can't do when you outsource it like that.
Great point.
Interesting observation, Mark.
Great point. So next category, sensitivity to market risk and liquidity. I think if we only had someone who was a former capital market specialist or supervised capital market specialist, he might have something. Oh, wait, no, Todd's on the line. Todd, what's your thoughts on sensitivity and market risk and liquidity?
It's been on the last couple supervisory letters. It's interesting. Last year, they couched all of this under that category of earnings and the impact on earnings. I can tell you what we've seen is NCUA's got their supervisory test. There's a huge focus on their NEV supervisory test. When you look at the numbers, though, across the industry, interest rate risk doesn't seem to be an issue, or it's not increasing anyway. It's actually having a little bit. Liquidity seems to be pretty good across the industry, but NCUA is always sensitive to liquidity. I think they've always been overly sensitive to liquidity. The agency just seems to be risk averse to liquidity risk. They don't tend to like borrowings and things of that nature. I don't see a lot of change in how NCUA is going to look at liquidity and interest rate risk, to be honest, going forward. It's in the letter most years, and I think it will always be there. Liquidity risk especially can have impacts on the insurance fund. I think the interest rate risk is something that's interesting because it's part of strategic risk. Generally, though, you can fix interest rate risk by spending a couple basis points of capital. Credit unions almost never fail from it. They get hurt by it. And sometimes when credit unions put themselves in bad interest rate risk positions, they make really bad decisions about credit risk to fix it rather than admitting they have a problem and fixing it. They try and mitigate it by taking on more credit risk, and that can cause problems. But I think it's just a bigger boogeyman than the agency makes it out to be at the end of the day. You can generally work through interest rate risk. Liquidity risk is a little bit different. Like Steve says, the models for forecasting liquidity risk, we see a lot of findings directed at people's tools for forecasting their liquidity risk. Hopefully over time, those get better as well. And we do see lots of doors and exam findings targeting liquidity forecasting models. I think that will continue. But I don't see this being any more different than it has been the last several years.
And generally, we're seeing less of it in our conversations and clients where when rates shot up 500 basis points, there was more of a shock and awe exam approach than now. There's still coming up, but not in every institution.
Well, when rates shot up and then you have a model that does another 300, of course, everyone's going to be failing. And that's why they got rid of the extreme category. And I think another reason this is moderating, and this happens every rate change. When rates change, you have to adjust your shares right away and loans catch up. And we've seen that with the rate change. Everyone's margins got compressions, NIMs got compressed, earnings got stressed. So there was a big focus on it. But really in 2025 now, the loan rates are catching up and net interest margins are expanding again and looking a lot better. Earnings are improving, so there's going to be a little less emphasis on that. I'll just throw something that's maybe not in this letter that probably should be talked about in earnings, and maybe it comes up in the next section, is there is a troubling trend in credit union's operating expenses are growing relative to assets. And that's been going on for a couple of years. That is troubling long-term to see expenses rising, and you're not seeing that in their competitive industries, the banking industry. Their expenses aren't going up. Credit union's expenses are going up.
Can I jump back just one more thing on liquidity, Todd? And this one I want to almost direct towards you. It has to do, they had a message in there on diversified funding. And I have concerns mainly because the competition is increasing daily. There's like 15 banks that were chartered in the last year. And it was funny, they referred to them as novel in approach. So certainly that's going to increase competition. And usually in a regulatory word, the word novel is very scary, but they've streamlined their approval process for new banks.
And two of those new banks were Ford and General Motors.
Yeah. So that hits on both sides, on the lending and the savings. So there's increased competition from private credit and non-bank entities. Can you
hear me, Mark?
Because there's these big generational differences into how they approach their savings, and it's huge between each one of them. And so credit unions have to really be on top of that and how they're reaching out to try and build that share portfolio.
Steve, you were on fire there, but you were cutting in and out.
Michael from Olden Lane talked about this on the cruise last week. He kind of had a whole presentation about where do you find your members in this transfer of wealth and how do you keep them when you find them? So first off, look at 2025. Credit unions paid down borrowed money. They did actually pretty good at collecting funds in 2025 and diversifying their balance sheet. But long-term, yes, Steve, this is going to be a big challenge for all the CEOs is where do you get your new members and where do you get your funding in the future? I have a population of two, a son and a daughter. Daughter, fairly loyal, still has the same bank account she opened 15 years ago. Son, no loyalty at all, man. Entirely on rewards program, and when he doesn't have a rewards, his money is somewhere else. A lot of the younger folks are more focused on investing as opposed to leaving money in institutions. So funding sources are a big challenge. And how do you get new members and how do you get the new generation to come into your credit union? And being an orphan, meaning I've lost all my parents and my wife have lost all her parents. Their money didn't stay where it was when they passed it on to the children. So I think that is a big challenge long-term for the whole industry is how do they gain new members and new deposits from the next generations coming up who's they have more information available at their fingertips at the internet. So it's not the branch down the street. It's, hey, where's the best deal online? And it's a huge challenge for credit unions. They're still going to bring in members with branch networks, but nowadays, you can move across the country and you don't need to change your bank. Her daughter's in Nashville and she's still keeping the same account she opened here in Billings, Montana. Because she's got remote capture on the checks, does everything with bill pay, not a reason to move. And I have a son, he'll move in a heartbeat just for a reward, no loyalty to anything. So I think that's a big challenge for the industry coming up. We don't talk about it. Neither of us are experts in it, but I think social media presence is going to be huge to stay engaged with the generations coming up.
In 15 seconds.
No advice to clients on how to do that. I just know they have to
Yeah,
do it.
you just know the war is coming. And as you talk about that, I grabbed my phone because there's a podcast mentioned here on occasion, but it's called FinTech Takes. And ironically, the host is a guy named Alex Johnson who lives in Montana, just like you guys. I don't know. There's something in the water there with all these smart people in Montana, but he's gone down some rabbit holes. The podcast, if you like podcasts, I'm telling you guys this, but to the listeners, the FinTech Takes is a fabulous podcast. They have one episode a month called This Is Not FinTech Investment Advice. And then they talk about really cool investment options out there, but they preface it with, don't buy this. We just think it might be cool. Anyway, every once in a while, he'll go down a rabbit hole on gambling, sports gambling, and without rambling about the problems that's creating, and every ad on the NFL games are tied to the gambling, but he talks about the fact that's burning up savings ability, right? So it's just another way that financial institutions are not able to get access to funds because people are burning up the money by losing money gambling. And there is a sister podcast to that called Bank Nerd Corner with Kia Hazlitt, and those two also are on each other's podcast, but check those out. Any thoughts on sports gambling? And Todd, I see you got a follow-up point.
Couple things. Like the last couple big bank failures were liquidity crises triggered by folks on social media. So basically you got crowd knowledge spreading very quickly, which triggered those liquidity runs. The gambling thing, and you can edit this out if you want. There's a couple interesting pieces to this. We have a lot of gambling in Montana, and when I was an examiner, I used to go through overdrawn accounts, and you would see people got a paycheck, and over 2 days, they spent that whole paycheck ATM withdrawals at casinos. And then the other side of that, I was at a credit union also here in Montana, and the collector comes up to me and he said, is there any problems if I go like on payday to the casinos to go collect money? And it's just, I don't want to hear about that. Don't tell me about it. I don't want to hear about it. You go collect your money at the casinos because that's where your members are spending it. Said you can edit that out. Probably not appropriate for your collectors to be in casinos on paydays, but
I'm going to leave it in, Todd. I'm going to live on the edge.
In his case, I said, hey, I don't want to hear about it. I'm not telling you yes or no. Well, the answer is probably no, because you go collect money because I'd rather not deal with your charge-off problems.
Just collect the loans.
We digressed away from the supervisory letter, but that's okay.
We did, but that's okay. That's when it gets more fun. Earnings and
Back on the operating expenses there, Todd.
Back to operating expenses. So we talked about a little bit about that issue and the challenges, and some of it's inflation, some of it's credit unions staff needing to be compensated so that they can keep them, but that's a pressure point for sure. Anything else on earnings and capital adequacy or the expense side?
Mine on that is we'd like to see credit unions put their capital to work. And we think that's a good point, not necessarily shared by every examiner who are risk adverse. So they're people too. But what we think, Todd, how much of the increase in expenses do you think it's from replacing legacy systems to scale up and increase the use of technology?
I think it's a little bit of all of it, Steve, and it depends on the credit union. Certainly amongst our clients, we've seen a number of them have went through conversions. You see a lot of credit unions that are sitting there at that $8 billion range. They start spending a lot of money to get ready for the leap to $10 billion when their regulatory burden and all their capital planning and stress testing becomes much greater. They get a second regulator thrown into things. Certainly during COVID, you get a hiatus on these conversions and moving forward when everyone's off site. There was a holding pattern and people are playing catch up on stuff. I think some of it is you just had an explosion of inflation and now you're catching up with some of that with your staff salaries and things of that nature. Insurance costs are escalating. So I think it's just a little bit of everything, and a lot of credit unions, and if their earnings are positive, their mindsets aren't necessarily focused on that. And I know when Steve and we said we started out together in the late 80s, early 90s, NCUA was hyper-focused on expenses. And somewhere in the early 90s, 92, 93, As examiners, we're told to not worry about expenses and told to not look at them. And that culturally has remained there. Earnings are present. Examiners aren't supposed to have this discussion on expenses. But we've seen with clients here recently that they have. They have started picking on expenses in select situations, sometimes unfairly even. But certainly as the industry, individual boards, credit unions, you need to keep an eye on those expenses. And it's a matter of, can you grow your interest income and fee income and stuff to overcome that? And it's back to what you said. You used the word scale, Steve. You got to be able to scale up to keep that expense number under control. Big challenge.
Yeah, I know one of the other things I've been reading about is that how do you diversify that income stream? So we can do that when interest rates change. You can gain fees on refinances of real estate loans, but I think we're trying to look towards new sources to diversify fee income. And I think some of that does come with the technology innovation that we've seen in some of our clients.
Or you create new loan products. Like one of the interesting things, if you look at the real estate lending, you're seeing a lot of growth in hybrid type loans again. Not your standard fixed rates, not your standard ARMs, but the hybrid loan categories are growing again. I think that's a lot of credit unions are trying to put real estate loans on your balance sheet. I know even when I was still an examiner, before I retired in 2021, you're seeing a lot of this on the West Coast where people were creating their own real estate products. Didn't meet secondary markets in terms. A lot of the credit did, but they were trying to create unique products to reach out to members, make housing more affordable, but still create a product they could keep on their balance sheet for interest rate and liquidity purposes. You're seeing AI unsecured type lending coming about. Here's AI jumping into the marketplace, creating a new type of loan. But certainly folks have to pay attention to cost and what's costing them and who's paying for it. Who's your members that are generating profitability for you versus those that are not, and how do you make those that are not become profitable or break even type people? Big challenge.
Yeah, my hope is that the regulators don't harm the ability of the institutions to foster innovation in the industry.
I had some summary comments about that at the end.
Let's revisit it also. It's worth it.
I think you're implying that we may have seen that on occasion.
It's
Of
like
course you-
Steve said, there's a risk. I'll just wait till the end.
That's good. This is what you do to make sure the listeners wait all the way till the end for that final point. So you just got to make a good one. All right. Operational risk management.
We kind of skipped earnings and capital. I want to just say one thing.
Earnings and capital. All right. Back to earnings and capital.
We were talking about liquidity and it led into it because in the
led.
prior
It was.
year, those were combined. This year, they separate them a little bit. But I think it's interesting in what they took out of this letter, because in the prior year, they had guidance citations on risk-based capital planning and stress testing, net worth ratio, and prompt corrective action. And they took those out of this letter. But they took them out of the letter right at a time where in 2025, we were seeing doors and findings on capital planning and justifying your capital levels and sensitivity testing on your capital levels. And they took those little pieces out of that this year. They're still in the wording somewhat that examiners will still assess earnings, make sure you have capital. But last year, it was very focused on capital in the letter. They had guidance specific to capital. We've seen a lot of doors and findings on capital. And I think it's interesting that those little pieces were removed from the letter this year.
Yeah.
Right.
And that one, as you're saying that, I'm thinking the priority is the priority, but on the front end, they talk about risk focus and that they can pivot to wherever they want. And situationally, those things will still get brought up if NCUA and your exam team thinks they need to be. These are the priorities. It doesn't mean you're not going to have to deal with other risks and every other type of risk. But great point, Todd. Steve, any thoughts on that?
No, that's good.
Excuse me, I'm going to have to hit the cough button. Operational risk management. We got payment systems made a reference to a 1 sentence paragraph on payment systems and another sentence on payment systems. And then they hit payment systems in the last sentence there.
I think they're worried about the justified keeping their payment system specialists that they just added a couple of years ago.
Or they're worried about Venmo linking to PayPal and stable coins and all the different clearings. I was listening to
And Zelle and
Zelle and how all of those link together. And I have an accounting degree, but I'm glad I don't have to balance anybody's Fed account.
we talked about, right at the tip of my thumb, Venmo.
And
And an earlier podcast, the number of young people that use Venmo accounts, it was a huge percentage. And I don't have those stats because I didn't think we would talk about that today. But you mentioned the social media aspects to Venmo accounts and the controls you need with that. The big scheme of things with payment systems here is you just have all these non-financial institutions entering into this payment systems arena. And I think the explosion of your cryptocurrencies have a lot to do with that too. You need to create ways to transfer money here and there. It's because people like my son have money in 15 different banks because of reward programs. How do you move money around? Let's not use the bank at all. Let's just use a third party thing. I do know the last car they bought, they used Venmo, even though that's limited to, at that time, it was limited to $10,000 at a pop, probably to get around the BSA requirements.
know your customer. Yeah. Yeah.
It's just an interesting thing, and the risks are growing there. And this was all under the cyber, in prior years, this was under the cybersecurity title, which they don't really mention this year. They just mention this payment systems, and BSA is a separate type of thing. And BSA has always been on these priority letters in one form or another. And I think a lot of that is because they have enforcement requirements that in agreements with other regulators that they have to follow.
Well, yeah. We have BSA a couple sections down, but yeah, good point on that. Steve, any more thoughts on this topic, payment systems, et cetera, before we pivot?
Yeah,
into-
I'm going to drag out my dog-eared proposed rule on corporate governance that I've always grabbing, and it talks about the importance of internal audit programs. And I think those are going to continue to become more and more important as we move into adopting these technologies. I think it needs to be a priority in your institution that you can say, we are very comfortable with the reviews that we're doing with these payment systems and even our compliance with we talk about later compliance, but the fraud prevention and detection. I think those people are going to be real critical. And that department also provides you a great source for your eventual people moving up in management. That has a lot of unintended positive consequences, and not having a proper internal audit has terrible unintended consequences.
That's a great point. Great point. Next up, fraud,
Now we can talk about
fraud protection, prevention, and detection. This fraud they bring up every once in a while. I used to do a chart. I don't have it here in front of me, but the priorities, there's perpetual, there's occasional, and there's new. The perpetuals are like the BSAs and asset quality. And up until this year, the perpetual was a separate category on cyber, but fraud is an occasional. It pops up every once in a while. And I don't know if they just say, hey, we haven't talked about fraud for a while, or there's something going on at NCUA. But thoughts on fraud prevention and detection as it relates to the letter and or anything else?
I think there's a couple pieces of this. As the insurer, NCUA is probably worried about fraud that impacts the failure of the credit union. But on the credit union side, you have to look at fraud as how do we protect our members? And here's the thing about technology is the bad guys are always the early adopters.
Right.
Yeah. You mentioned you were telling someone on the cruise about how you used an AI to create your voice that sounded close to yours. Some people wouldn't be able to, people that know you would be able to tell, others maybe not. There's a little fraud whole AI things where they'll call you and it's the whole speaker. And how do you protect your members, especially your older, less technology members, from getting scammed. And it might not be the credit union's fault at the end of the day from a legal standpoint, but from a strategic reputation thing, it is going to fall on the credit union if you let one of your members get scammed out of $40,000, $50,000 or what have you. And I think the big challenge for credit unions in the fraud thing, and it's not only to protect against fraud from your own employees, but the bigger challenge is how do you protect your members from all the schemes going on out there today?
Yeah, great
What
point.
kind of tools do you have in place to protect your members? That's a big one. And member retention is important. And this is back to the social media thing of grandma gets scammed and granddaughter starts putting a thing on Instagram or the TikTok or what have you. That has implications for you and the community and your reputation risk. So, that's, I think, probably one of the biggest challenges for credit unions is how do you protect your members from fraud? NCUA is worried about, well, the credit union doesn't fail because an employee steals money. I think the bigger challenge for management is how do you protect your members?
And along those lines, over the weekend, my wife was looking at Twitter /X, and she said, "Hey, look at this situation." It was someone talking about a credit union somewhere in the Midwest saying, "Hey, a relative of mine is reaching out to you saying that they don't have an account and they do have an account." And there was some references to funds being turned over to the state. I'm going, there are achievement laws, so if it was a dormant account, it could be tracked over that way. But then also it went on to imply that they'd reached out to the state and those funds weren't there. And there it was on this particular financial institution's Twitter account. And there was really good responses from that institution saying, "Hey, you can reach me at this number. Let me help." But the struggle is real.
Yeah, I would say, how would you respond to this question? How are you rolling out smarter controls that strengthen account security and accuracy? So,
Is that from your dog-eared risk
No.
report?
no, it's not
No,
my own thought, but it was
that's-
one I found useful.
I like it. I like it. All right. Fraud prevention, detection, anything else before we pivot into what's not in compliance or what is in compliance, which is BSA?
We talked about it. They have responsibilities to other agencies to enforce it. They have compliance people. It's always been a required part of exams to look at BSA and those risk assessments. And like Steve came back to, one of the things NCUA looks at is they want to know, credits, have you done your own risk assessment on this? And how good is that risk assessment? And that plays into your risk management process, into your internal audit processes. And this is one where just having conserved credit unions, it doesn't get talked about a lot, but you get sideways with FinCEN and they can issue fines really quickly that can become significant really quickly too.
Yeah, the math can a lot of times end up not actually collecting the fines, but the fines can be scary to the point where it can impact solvency and or your capital category even.
In my conserved credit unions, I turned this over to NCUA's legal counsel. It's, man, go talk to the FinCEN people. We can't afford to pay it. NCUA's general counsel did a pretty good job of getting fines mitigated or getting them negotiated down as long as we got things fixed in a very short period of time.
Yeah, we were able to argue because we conserved it and we are in the federal government's now in charge, there's no need to do the fine, and that worked a few times as well. Not that's a reason to conserve, but the conservatorship in that instance helped us save the reserves for the credit unions, its members, and then of course, obviously the fund on the backstop.
In my case, it was always I found out about them after we conserved that these fines were hanging out there. Or sometimes, one time, we self-reported a problem that we found, and then they fined us for self-reporting that we weren't complying, and how do we fix it?
That sounds like the internal audit staff that Steve says people should have at their credit unions going to the credit union, going to the examiner saying, "We don't want you to have any surprises, so here's the things we're dealing with." And then their attachment shows up in their exam report. Haven't had that. We've had that happen more than once, I think, in 2025, but I digress. Be it so, the other takeaway here is Usually this would say consumer compliance, and we're going to look at this, and we're going to look at this, and we're going to look at this, and we're going to look at this. And oh, by the way, we always have to look at BSA, but because it's not a Democratic-led, Todd Harper-led letter to credit unions, it's a Republican-led, Kyle Hauptman-led letter to credit unions. This is the lightest touch there's been on consumer compliance for many years. Even other Republicans had more on consumer compliance than this letter has. Fair lending exams, other things. And you've got the CFPB gutted. This administration is not consumer compliance friendly, and that pendulum is swung about as far as I've ever seen it. Any thoughts?
I'll throw a guess out there, and you could probably tell me in your time as executive director whether my guess is right or not. NCUA is responsible for enforcing a multitude of these consumer compliance regs until the credit union hits $10 billion. There's always been the question. At one time, NCUA used to have compliance examiners. One of our first RDs and supervisors, Steve, Bob, Blattner, Dan Murphy, started NCUA as compliance examiners and rose to be directors, regional directors. And there's always this question, do you bring compliance examiners back? NCUA has not done it. So I think we've always rotated, focusing on different aspects of it for a couple reasons. One, it keeps the credit unions focused on it. And two, it's a way to train your examiners. You can't train them all to be compliance examiners, but you train them on 2 or 3 things this year and 2 or 3 things that year. And it keeps the generalist aware of all the consumer compliance regs without NCUA hiring a compliance examiner. I always thought that was the intent of that. It just keeps people generally aware. I would say my career as an examiner, a lot of the compliance issues, you find them as you're doing something else, not because you're looking for them specifically. Right. And by having a rotating thing, it just rotates your training, keeps your examiners up to speed, avoids this whole issue of hiring compliance examiners. So you as an executive, I don't know how close am I to being right to that's the why they did it or not. That was just my kind of guess.
I would say that you're closer to right than in you're roughly correct category. I made the reference to someone who used to say the term roughly correct as a little squishy. You're much more close to the reality of what it is that you see on the 7th floor when you're trying to figure out what should be in there. You rotate it through, keep people fresh. And the other, just pivoting, there's a lot of good league programs. There's a lot of good America's Credit Unions program. NAFCA used to do certain things. Credit unions would actually train us because they had other good sources. The examiners would learn a lot from the credit unions until you saw something that went wrong, perhaps because of a lawsuit, et cetera, et cetera. But yet, and then Todd Harper was contemplating, and I think did start doing some separate compliance exams under 10 billion as a prep to getting ready for 10 billion. And now, here, by the way, the CFPB has responsibility for over 10 billion in consumer compliance, yet they don't have any staff. So interesting times for sure. So I'm to the letter part where it talks about the conclusion, which means we're to the end where we're going to talk about the other fun stuff that we deferred. Steve, Todd?
Your favorite, though, it does say, hey, record your exits and record your JCs.
It does.
That sentence I highlighted.
I'm glad that's one of the 3 sentences you highlighted. And again, Kyle Hauptman was a big proponent of recording your JCs. And he does give the hat tip to the fact that some states don't allow it. We've been involved in situations where our clients do it. We've recommended doing it just because it creates the actual official record. And I think the more NCUA has seen people doing it, they've become more and more comfortable that it happens. And you're going to have less of a chance of some rogue cowboy examiner, although a lot of those probably retired, going down and saying some things that maybe they went beyond where they're supposed to. So it does create a clarity of what's said.
Other rogue examiners will appear. And I don't care when you have 1,000 employees, there's always going to be a few rogues out there.
Yeah, that's a fact. Life, I always say this, life is a bell curve, whether it's going out to dinner or whether it's the result of your NCUA exam or whether it's how well a credit union is doing complying with the regulation. Everything tracks back to that bell curve.
One of my other duties, as a director of special actions, I also sat on NCUA Supervisory Review Committee where dealt with credit union appeals. And let's just say if you ever go down an appeal path, having recordings could be extremely helpful to your case.
Great,
And it makes the committee's job 100 times easier.
great point. And I'm sure you saw whoa, that was said, but then we're going to vote this way.
Always surprises when you sit on those committees of things that actually went on.
Great point. What other final thoughts here on this podcast, on this topic, or other general thoughts, guys?
You opened the cruise with a session on the chaos at NCUA. You've talked about this on a lot of your other podcasts, and you have this conversation with many of our clients at the chaos at NCUA. And Steve mentioned something, and I have this in really big letters at the bottom of my sheet, a big box. It says risk aversion. Can I get it so the camera can
It's just
see it? Anyway, there's a big box at the bottom of my paper. It says risk adverse. And here's what kind of happens at NCUA is you start out as a new examiner. You're nervous about all the responsibility that's laid on your shoulders. You tend to start out your career as a very risk adverse person. And then depending on your general nature, you become more comfortable with risk and how it's managed and controlled. Over time, you understand long-term implications that credit unions, if they're going to remain here as an industry, they need to be innovative. They need to take some risks. And you kind of learn here's how do you help them manage and control risks with new programs and things. And then you have other examiners as they move through their career, that risk aversion never ever leaves. And they even end up in management positions and they're still risk adverse. But the whole part at NCUA, they've lost 27% of their staff. And you've always had this kind of balanced scale. You've got people that are comfortable with risk, people less comfortable. And I think a lot of the people that have left were your longtime employees, and those are the people that were probably more comfortable with risk. And so now you've got an agency where on the balance scales, a larger proportion of their staff than ever are going to be risk adverse type people. And risk averse people, they try to do is CYA and make sure I'm not responsible for anything. So how does that play out here with what's going on in the regions? The people that have left, it's not uniform across the agency. You've got a hodgepodge of this region lost more supervisors, this one lost more specialists. The interesting thing is there's no public information out there as to how this is played out or who's left or what's going on. It's interesting. NCUA hasn't done any public podcasts on that. They haven't done a podcast on this supervisory letter, which they've done in the past.
They're doing
So,
one.
no
late,
question.
They're doing one late February. They're going to.
Oh, is that right? I missed that email. But anyway,
17% of the year will be gone, and they're going to brief it. And I mentioned this in my emergency podcast. I sent you guys my cool new emergency podcast music. I appreciated your thumbs up feedback on that. But in that podcast, I said at the board table, they said we're doing something in February. And I channeled one or both of you, and I said, hopefully they do more than just read the letter. Because some of their recent podcasts have been just, we will read you the letter. Do you have any questions? And then the questions sometimes do lead to some discussion. But anyway, all right, I digress. Where were we?
so anyways, I think what's going to happen is because you're going to have this CYA thing. They talk about individual exams. Let me go back to the front of the letter where they say, focused on, anyway, somewhere in here they have a thing. We're going to basically focus on individual characteristics of credit unions. What it really means is they're going to be trying to find outliers. And I think what's going to happen is if you look around, NCUA's got all these risk reports. They got these things called rate reviews. A lot of these are very static. A lot of them have false positives. So even though you have a national supervision policy manual, which they tend to quietly be changing without talking to the public about, separate issue, you're going to find that almost all the risk trends are noticed in the regions before they're noticed nationally. And even though you have these national risk reports and rate reviews, all the regions, they generate their own risk reports based on what they're seeing. And they see aggregate exam findings way before the national office does. So I think what you're going to see is you're going to start seeing some differences in the regions because the regions are going to start getting more involved in their own risk assessments, credit unions at their supervisory level. They're going to start driving what happens within these credit unions. When you cut off time like this and they don't have resources to do their job, you're going to start seeing the CYA thing. So they're going to lower CAMEL ratings. They're going to put doors and EFs in as an abundance of caution. There's going to be less negotiations with credit unions about it. They'll start addressing symptoms, the issues, and not really the root causes of problems. And this goes back to something that Steve said earlier is when I was the director of special actions and my staff wrote doors, one of the first things I always looked at is this going to do more harm than good? Because the last thing I wanted to do is see a door climbing that does more harm than good. It addresses a problem, but does it create bigger ones? I think we're going to see more of those because they're cut short on time. They're going to address the symptoms as an agency just because of all the chaos going on, the experienced staff they've missed. We're going to see more doors and findings that do more harm than good because they're going to be trying to do a CYA. And I think they'll be building a case for that with CAMEL ratings and things that we don't have enough resources to do our job. Exam points going to go up. SEs are going to be complaining continually. I don't have a resources to do my job. And it affects everyone. The examiners are less experienced. You're going to have a whole bunch of new SEs because they lost a lot of supervisors. Maybe not in every region, but some regions lost a lot of supervisors. So you're going to have less experienced supervisors. I don't know at the regional level, the quality control. I assume the same thing has happened there. You've got the most experienced people there have left. You've got experienced executives left. And smart people are going to figure it out. And NCUA is going to figure it out. But this chaos is going to create some turmoil here for a period of time. And you're going to see SEs and regions doing their own thing to figure who the outliers are. And if you get people that deviate far from peer, they're going to get highlighted and targeted. So this whole chaos type thing, I just think it's going to make your examiners more challenging. Examiners are going to want to write findings and doors to move on. They're going to say, I found it. I didn't have time to fix it. They're going to address symptoms, not root causes. So it's going to be challenging for everyone. I see the thing on one of the LinkedIn posts, a person, hey, I'm glad for NCUA's budget cuts. My exam time's going to be shortened. I have to deal with them less. And this is one of those be careful what you wish for kind of things.
Yeah. A lot of things there.
Go up, the pendulum will swing back the other way. NCUA did need to reduce staff at 27%, and you can't control where and how that's done. They probably don't have enough resources to do all their legislatively mandated requirements to protect that insurance fund. They're going to pick and choose and triage and do the best they can. And there's going to be some casualties along the way.
It's just like a MASH unit. And Steve, I've got some thoughts about what Todd said, but Steve, any other thoughts that you have or any comments on what Todd said?
Probably a little different, but just from what we've observed throughout the year to say what I'd like to see a change in NCUA is more cooperative production in the documents of resolution and how the problems will be fixed, not mandating from the examiner. That would, to me, would be a really big, important step that we would stop hearing. They didn't even talk to us about it. We just got this door and we just got it in the meetings next week.
Great point. That's probably if you had to say what was the biggest bad trend in exams in our clients last year, that was probably it. Reminds me of a Suzanne song. It's a one-time thing. It just happens a lot. We've been seeing that quite a bit. And then pivoting back to what Todd said, I wrote down in my red pen here, you know, the CY, you have growing pains, but what NCUA is having is shrinking pains. And something I've mentioned on the podcast here on occasions, Todd, you're talking about that they're risk averse, they're less experienced, that they may put their thumb on CYA, they may put their thumb on CAMEL. And my underlying fear about the combination of the 27% and the combination of the changes they made to their CAMEL requirements, they basically weren't able to do their exams in compliance with our requirements when they were fully staffed. So they tweaked that. Then they go down 27%. Then they say, you don't have to do 120-day contact in Camel 4s. You don't have to do 180-day contacting in Camel 3s. But one argument would be, wow, they don't have the staff, so they're not going to overreact. And those on the border, if you might be a 2, you might be a 3, we'll code you a 2 because I don't have the time to come back. A CYA mindset of that is, guys, you just told me I don't even have to do a follow-up. I can make them a 3 and not have to go in there. That's perfect for me because I'm saying there's some risk there, but you're not going to give me the time, which goes into the Camel. When you see an examiner who's not comfortable talking about Camel, getting the Camel question by a credit union, what they'll say is, it's just a resource tool that we use for where we have to go. And they've blown up the fact that that argument's gone because they're saying you don't necessarily have to go to the 4s as often. You don't necessarily have to go to the 3s. And I get why they did that, but it could have a perverse impact. It's easy for me to code you a 3 and then just not come back. Because before I had to come back and I'd have to deal with it. So I don't think that's going to be often, but it will happen. And I'm sure also maybe we'll do a podcast on that when we have a client where it appears to have fit that category. And deviation from the peer, they're going to be doing more offsite statistical analysis. How many standard deviations are your way? You got the rate reports, you've got the individual region reports. But all right, that's all I've got on this. Any other last comments before we wrap up this episode of With Flying Colors, guys? All right.
Steve, you didn't use the word you tempted me. You thought this whole letter was a word salad.
That's kind of
Like,
I was
a word salad.
Yeah, I did take the letter and I had AI give me a summary, and it took a 5-page letter and it reduced it down to a page and a quarter.
And it's definitely a different type of letter than I've seen recently. And one thought that popped into my head is, and I know NCUA, or at least until recently, wasn't allowed to let their people use AI. It had a little bit of an AI feel to it, the way it condensed things and summarize things. And I may be totally off track there. It may be that Helpman said, I want this to be more simple. And then what happens is E&I goes, yeah, but we got to say a sentence about this. So if I'm not allowed to have more than 4 priorities or however many we have, I'll just weave it in here. And then I'll put 6 attachments that have 800 pages to it so that really it still encompasses everything. Said another way, it's a risk-based exam. This kind of tells you what NCUA is thinking, but it doesn't mean that you won't have to deal with other things when NCUA comes in. All right, guys, as always, thank you for your time. Stay warm. I'll do the same. And listeners, watchers, as always, I want to thank you for watching. Thank you for listening. I hope you'll listen again soon or watch. And this is Mark Treichel signing off with Flying Colors.